Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about NEWELL Brands INC quarterly report. NEWELL Brands Inc. offers a diverse range of products and services across three segments: home and commercial solutions, learning and development, and outdoor and recreation. The company's product offerings include household products, kitchen appliances, small appliances, food storage, cleaning and maintenance solutions, closet and garage organization, products hygiene systems and material handling solutions, writing instruments and art supplies, baby gear, and infant care products, outdoor and outdoor-related products, technical apparel. On-the-go beverageware. The company serves various customers including warehouse clubs, department stores, specialty retailers, office superstores, contract stationers, e-commerce retailers, and direct-to-consumer online sales. NEWELL Brands Inc.'s stock price crash. A perfect storm of disappointments in the past year. NEWELL Brands Inc.'s NWL stock price has plummeted by an astonishing 59.38%. The decline can be attributed to a perfect storm of disappointing financial results, lowered outlooks, escalating tariff costs, and a challenging macroeconomic environment. The company's consistent revenue and core sales declines have been a major concern. Despite efforts to revamp its business strategy, NEWELL Brands has struggled to stem the tide of declining sales. Missed earnings and lowered financial outlooks have further eroded investor confidence, with the company repeatedly missing analyst expectations for earnings per share, EPS, and revenue. The escalating tariff costs have also taken a significant toll on the company's bottom line. With an estimated $180 million in incremental cash tariff costs for 2025, NEWELL Brands is facing substantial financial strain. The challenging macroeconomic environment, characterized by persistent inflationary pressures, soft global consumer demand, and weakness in international markets, has further exacerbated the situation. The company's high leverage and financial strain have also raised concerns among investors. With a debt-to-equity ratio of 2.09 and an Altman Z-score of 0.47, NEWELL Brands is at risk of bankruptcy within 2 years. The sharp declines in stock price following the Q3 2025 earnings announcement and guidance cut are a testament to the company's financial struggles. In conclusion, NEWELL Brands Inc.'s stock price crash can be attributed to a combination of disappointing financial results, lowered outlooks, escalating tariff costs, and a challenging macroeconomic environment. The company's high leverage and financial strain have raised concerns among investors, making it essential for NEWELL Brands to revamp its business strategy and address these issues to regain investor confidence. The primary drivers of revenue growth or decline can be summarized into several key factors. Revenue decline is primarily driven by soft global demand, inflationary pressures, and fluctuating interest rates. Additionally, changes in consumer discretionary spending patterns due to price increases and tariffs have also contributed to the decline. Seasonality of sales volume and volatility in future demand patterns further exacerbate the issue. On the other hand, revenue growth can be attributed to product and commercial innovation, distribution expansion, and international market penetration. The home and commercial solutions segment has seen a 6% YoY revenue increase, while the learning and development segment has experienced growth despite declining income. Net income and profit margin changes. A turning point for the company's financial performance has undergone a significant transformation between 2024 and 2025. Net income, which was a loss of $162 million in 2024, turned into a gain of $30 million in 2025, marking an impressive increase of $192 million. This improvement is attributed to various factors, including operating income growth, lower non-cash impairment charges, and cost savings from restructuring actions. Profit margins have also shown a notable shift. While gross margin decreased slightly from 34.9% to 34.1%, operating margin has made significant strides, increasing from -6.2% in 2024 to 6.6% in 2025. This improvement is largely due to the absence of a substantial impairment charge of $260 million in 2024. Segment-wise analysis reveals that all three segments have shown improvement in their operating margins. The Home and Commercial Solutions segment saw its operating margin improve from -9% to 4.2%, while the Learning and Development segment's operating margin increased from 10.5% to 18.2%. Even the Outdoor and Recreation segment, which had struggled with a minus 12.6% operating margin in 2024, managed to improve its performance to minus 4.4% in 2025. Overall, these changes indicate that the company has successfully turned around its financial performance, driven by improved operating income, reduced impairment charges, and cost savings. The company's financial performance indicates a positive trend in its operating cash flow. According to multiple sources within the financial summary, including page 15 and page 26, the company has generated significant amounts of positive operating cash flow. Additionally, the 9-month period ending September 30, 2025, saw an operating income of $311 million, further solidifying this conclusion. As a result, it can be confidently stated that the company is generating positive operating cash flow. The company's debt level and interest expenses have undergone significant changes over the past year. In terms of debt level, short-term debt has increased substantially from $87 million to $237 million, while long-term debt has only marginally increased from $4,508 million to $4,540 million. However, total debt has decreased by 6.3% due to a significant redemption of senior notes in June 2025. Interest expenses have also seen an increase, with interest expense net rising by $8 million, 10.7%, and $14 million, 6.3%. Furthermore, the loss on extinguishment and modification of debt has increased significantly from $1 million in 2024 to $13 million in 2025 due to the redemption of senior notes. The issuance of new senior notes with an 8.5% interest rate in May 2025 is a notable development that will likely impact future interest expenses. Overall, while total debt has decreased, the company's interest expenses have increased, indicating a potential shift in its financial obligations. The company's financial performance varied across different segments and regions. The Home and Commercial Solutions segment, as well as the corporate division, were notable underperformers. In contrast, the Learning and Development and Outdoor and Recreation segments showed neutral results, neither significantly outpacing nor falling behind expectations. Management's outlook on company strategy. The company's management has expressed a cautious outlook for the short term due to seasonality and uncertainty in consumer demand. However, they are optimistic about their long-term strategy, which focuses on strengthening commercial capabilities, unlocking operational efficiencies, and implementing a standardized approach to drive scale. To achieve this, the company will continue to review its operating footprint and non-core brands, leading to potential restructuring and charges. Additionally, management is aware of the impact of tariffs and trade environment, anticipating an incremental cash tariff cost of $180 million in 2025. To mitigate this, they plan to deploy a pricing, productivity, and relocation strategy. The company has also made significant investments in product innovations and launches, which are expected to drive future growth. With a focus on operational efficiency and strategic investments, management is confident about the company's long-term prospects despite short-term challenges. The company's financial summary highlights its acquisitions and divestitures. Notably, there were no acquisitions made throughout the report period. However, the company did engage in several divestitures. Key divestiture activities include selling its equity interest in a joint venture, resulting in a $12 million pre-tax gain, disposing of businesses, which led to losses of minus $12 million in 2025 and $2 million in 2024. Exiting certain business segments, including the kitchen business, which had an unfavorable impact on net sales by approximately 1%. Closing facilities associated with restructuring activities. The divestitures resulted in higher proceeds in 2025 compared to 2024. The company has a history of paying dividends to its shareholders. In the recent years, it declared dividends on common stock with varying amounts, $0.21 per share in 2023 and $0.07 per share in 2024. The total dividend payments for these years were $-90 million and $-31 million respectively. Concerns about inventory buildup or supply chain disruption are evident in our financial summary. Inventory levels have been a concern, particularly in the L&D segment, where retailer inventory has decreased significantly. This is reflected in the $68 million decrease in finished products and the $7 million increase in raw materials and supplies. Furthermore, supply chain disruptions due to geopolitical and macroeconomic conditions, as well as tariffs imposed by the U.S. and retaliatory tariffs from foreign countries, pose a significant risk. These disruptions may impact our supply chain, as highlighted in the Risk Factors section of Part I, Item 1A. That concludes the financial summary for NEWELL Brands Inc. Feel free to comment below, and I will be happy to answer them when possible.